Welcome to Breaking News to Trading Moves. We are skipping the usual warm-up today because we have a substantial transaction on the tape that we need to analyze.
We do.
We're looking at a separation, essentially. Western Digital, that's ticker WDC, has officially announced plans to liquidate its remaining stake in SanDisk.
Ticker SNDK.
Right.
And it is a decisive move. We're looking at a secondary share sale valued at approximately $3.09 billion. That's the headline number.
And just to set the parameters for everyone listening, our mission here is to look strictly at this headline. We'll identify the winners, the losers, and look at the market mechanics involved.
Exactly.
We aren't here to make wild predictions about the tech sector in 10 years. We're looking at the trade right in front of us.
Exactly. We want to understand the immediate impact. When a company decides to liquidate a stake of this size, over $3 billion, it creates some very distinct flows of capital.
Right.
It creates pressure in one area and, relief in another.
So let's start with the why. Western Digital didn't just wake up and decide to sell $3 billion worth of stock out of the blue. There are specific drivers here.
There are. The primary driver appears to be a tax deadline. Specifically, there's a deadline of February 21st, 2026.
Right.
Western Digital needed to address this position before that date.
That date is still a little ways away, though, so why move now?
Well, markets, they hate uncertainty. And corporate treasuries, they much prefer to be ahead of schedule.
Get it out of the way.
By moving now, they remove the risk of being forced to sell later under potentially worse conditions. But really, beyond the calendar, the motivation is balance sheet management.
Okay.
This sale is explicitly aimed at accelerating debt reduction for Western Digital.
That makes sense. It's house cleaning. But the way they're doing it is quite specific. It's not just a simple cash sale on the open market, right?
No, not at all.
There's a mechanism here called a debt-for-equity exchange.
That's right. This isn't Western Digital just hitting the sell button on a brokerage app. They're engaging in a debt-for-equity exchange, which involves swapping the equity they hold in SanDisk for the retirement of their own debt.
And they have help with that, I assume?
They do. To facilitate this, they're working with affiliates of major banks, specifically JP Morgan, ticker JPM, and Bank America, ticker BAC.
Okay, let's break that down because it sounds a little complex. Essentially, they are handing over the SanDisk shares to the banks.
Mm-hmm.
And in return, the banks are helping to extinguish a portion of Western Digital's debt. It's a transaction that cleans up the liability side of the ledger for WDC.
Without them needing to use cash from operations, precisely. It is an efficiency play.
And that explains the immediate market reaction we saw.
It does. SanDisk, ticker SNDK, it dipped. The market sees $3 billion of new supply or overhang coming onto the market.
And when supply goes up?
Price often adjusts downward to absorb it.
While on the flip side, Western Digital, WDC, it ticked up. The market looked at that and said, we like this.
Yeah, we approve. They're improving the balance sheet. They're lowering their leverage.
And it validates the pure play thesis, doesn't it?
It absolutely does. By exiting this stake, Western Digital is reinforcing its transition toward being a focused hard disk drive, or HDD, company.
A cleaner profile.
A much cleaner profile for investors. You aren't buying a conglomerate with a massive passive stake in another firm anymore. You're buying the operating business with less debt.
That brings us perfectly to our first category, the winners. And we have to start with the obvious one we just mentioned, Western Digital itself.
They are. This falls squarely under the category of deleveraging and balance sheet beneficiaries. By using these proceeds to reduce debt, Western Digital just lowers its risk profile.
Lower debt means less interest expense,
which improves earnings quality immediately. And it creates flexibility. When you aren't servicing a massive debt load, you just have more options for the future.
Right. It frees up room for capital returns, like buybacks, down the road.
Exactly. The market tends to reward companies that proactively clean up their balance sheets, especially before a deadline forces their hand.
Now, in this same category, we have to mention Seagate Technology, ticker STX. They weren't involved in the deal at all, but they seem to be a winner here. Why is that?
It's the sympathy play. Seagate is the direct peer to Western Digital in the hard drive space. So when the market rewards a cleaner balance sheet and a focused HDD profile for Western Digital,
it reminds people about Seagate.
It reminds investors of the value in that business model. Seagate benefits from the spotlight being put on the sector's financial health.
So if investors are rotating into storage names with disciplined capital allocation, Seagate just what? Catches some of that flow?
They capture some of that flow just by being the other major player in the room. It's a rising tide for that specific hard drive niche.
Okay, let's look at the second category of winners. The deal and underwriting beneficiaries. We mentioned the banks earlier.
Yes, this is a massive transaction. And secondary offerings, these complex balance sheet transactions like debt for equity swaps, they create fee opportunities.
So JP Morgan Chase, ticker JPM, and Bank of America BAC, they're the ones executing this.
They are. They're handling the financing structures, the execution. For large banks, these capital markets fees are a core revenue stream.
And a $3 billion deal is not small.
Not at all. It generates fees. It's a volume game for them. And being the chosen partners for a deal of this size is a clear win for their investment banking desks.
It's good to be the middleman. All right, moving on to our third category of winners, the data center storage ecosystem. This feels a bit broader. We're looking at names like NetApp, NTAP, and Pure Storage, PSTG.
The logic here connects back to investor sentiment. If the market is rewarding stronger balance sheets and disciplined capital allocation in the storage sector, which is what the Western Digital move represents, that positive feeling can lift the broader group.
So if I'm an investor looking at storage and I see Western Digital getting its act together, I might look at NetApp or Pure Storage and just feel more confident about the whole sector.
That is the thinking. It signals that the storage sector is focusing on profitability and financial health, not just, growth at all costs.
And NetApp and Pure Storage are key players there.
Key players in the data center storage ecosystem. When the sector is in favor, these names often catch a bid.
Okay, that covers the winners. But in every trade, there is another side. Let's talk about the losers, and we have to start with the company whose shares are actually being sold. SanDisk.
SNDK.
Yes.
And this is the textbook definition of secondary offering overhang. This is category 1 for our losers.
Can you explain that concept of overhang for us? I feel like we hear it a lot, but how does it actually work in practice?
It's just supply pressure, pure and simple. Suddenly, there are $3.09 billion worth of shares looking for a home.
Lot of stock.
A lot. And even if the long-term story of SanDisk is perfectly intact, the short-term mechanics take over. To get buyers to absorb that much extra supply, the price usually has to drop. Buyers demand a discount to step in.
So it's not necessarily a reflection of SanDisk's business quality at all?
No, it's a reflection of the supply glut.
Yeah.
It caps the upside in the short run. It acts as a ceiling. Until that supply is fully absorbed by the market, the stock will struggle to move higher.
Right.
Think of it like a warehouse club. If they suddenly get a massive shipment of one item, they have to lower the price to clear the pallets.
Even if the product is great.
Even if the product is great.
That makes sense. And in the same bucket of supply overhang, we also have Silicon Motion Technology, ticker SIMO.
Yes, they're in a similar position regarding supply dynamics. When investors see a large block of stock hitting the market in a related name, they become wary of other names that might face similar events.
So Silicon Motion gets caught in that cautious sentiment.
It does.
Let's move to category 2 of the losers, flash and memory sentiment. This is where we see the crowded trade unwind.
The memory trade can be very, very correlated. When a high-flying spin-off or a memory-linked name like SanDisk wobbles, even if it's just because of a share, sale traders often react by de-risking the entire sector.
So they sell first and ask questions later.
Often, yes. If SanDisk is down, algorithms and sector-focused traders might trim their positions in other memory names to manage their overall risk exposure.
And that brings us to Micron Technology, ticker MU.
Micron is always the bellwether here.
So if SanDisk is under pressure, Micron takes a hit just by association.
It can. It's a sentiment-based move. Micron is a loser in the short term here because of that sector-wide de-risking. The same applies to KLA, ticker KLAC.
The equipment supplier.
Right. They're equipment suppliers, but they trade in the same basket. If the memory trade is cooling off because of the SanDisk news, KLA can see selling pressure as well.
It shows how interconnected these tickers are. You can't just look at one in isolation. Now, the third category of losers is a bit more nuanced. It's credit and leveraged balance sheet sensitivity.
This is the flip side of the Western Digital success story.
How so?
Well, Western Digital is being rewarded for reducing debt. The market is cheering that move. What does that tell you?
It tells me the market is worried about debt.
Exactly. It tells you that investors are prioritizing clean balance sheets. So when the market zooms in on debt reduction, they start to look critically at tech names that still have heavy leverage or refinancing needs. They reprice that risk.
So companies that have a lot of debt might look less attractive by comparison.
That's the risk. Hewlett-Packard Enterprise, ticker HDE, falls into this bucket. They have a different capital structure, and if the market is favoring the lean and mean approach of Western Digital, HPE might face scrutiny regarding its own leverage.
And Cogent Communications, CCUI, is another one mentioned here.
Yes, Cogent is another company where debt levels are a topic of conversation. If rates moved or spreads widen, these companies have more downside sensitivity. The Western Digital move really shines a spotlight on that vulnerability.
It makes investors ask, why aren't these guys paying down debt too?
Exactly.
So we've covered the mechanics, the winners, and the losers. But the trade isn't over just because the news is out. What are the key things to watch next?
The first thing is the pricing of the secondary offering itself.
We know the value is around $3 billion, but the specific price per share matters.
It matters immensely. We need to see the size of the discount. How much below the current market price do they have to sell these shares to clear them?
A steep discount would imply weak demand.
And a narrow discount implies strong demand. We also want to know who is buying, right? The quality of the demand.
Who anchors the deal?
Exactly. Is it long-term institutional investors who plan to hold the stock for years? Or is it hedge funds looking for a quick flip? The quality of the book will determine how SanDisk trades in the weeks following the sale.
Okay, what's the second thing to watch?
The follow-up from Western Digital. They've cleared this debt. What's the strategy now? We need to watch their capital allocation commentary.
So will they continue to prioritize debt paydown?
Or will they pivot? Now that the balance sheet is cleaner, will they start talking about buybacks or dividends? That pivot would be a major signal for the stock.
If they switch from fix the balance sheet mode to return cash to shareholders mode, that completely changes the investment case for WDC.
It does. And finally, we need to watch for stabilization in SanDisk, SNDK.
We mentioned that the real move often comes after the deal is absorbed.
That is the pattern. The stock drops on the news of the supply. It struggles while the deal is pricing. But once the supply clears, once the shares are in the hands of new owners, the pressure lifts.
So don't write it off just because of the dip. The dip is structural.
Correct. The dip is mechanical. If the fundamental story holds, the price often recovers once the mechanics play out.
Let's talk a little more about the implications for Western Digital. We touched on the pure play angle. Is this the end of their transformation, or is this just a step?
It feels like a culminating step. For years, Western Digital has been trying to figure out the right mix between flash memory and hard drives. By liquidating this stake, they are effectively casting their vote. They are betting on their core competency in the HDD market.
And that market, the hard drive market, is all about the cloud now, isn't it? It's not just about laptops anymore.
No, it's about mass capacity storage. That's where Seagate and Western Digital live. By cleaning up the balance sheet, Western Digital is saying they want to be lean enough to compete aggressively in that cloud storage arena.
It allows them to invest in the technology rather than just servicing debt.
That's the key. Debt service is dead money. R&D is future money. This swap moves capital from the dead column to the potential column.
I want to circle back to the banks for a moment, JPM and BAC. We said they are winners because of fees. Is there risk for them in a deal like this?
There is always risk. If the market suddenly tanks while they are holding the shares, before they can sell them, they could take a loss.
But that's unlikely.
It is. Usually these deals are pre-marketed or they build a book of demand very, very quickly. They don't typically hold that inventory for long. The fact they took the deal suggests that despite the dip, there is institutional appetite for SanDisk shares at the right price.
That's a good point. The fact that the deal is happening at all is a signal that there is liquidity in the market.
Yes. If the market were truly broken or terrified of tech, you wouldn't see a $3 billion secondary offering launching. The window is open.
So if we wrap this up with a quick summary, it really feels like a classic split, doesn't it? A split between the seller and the company being sold.
It is a classic divergence. SanDisk, SNDK, dips on the immediate supply shock. Western Digital, WDC, firms up on the promise of financial flexibility.
Western Digital is essentially trading an asset for a cleaner future.
That is the trade. And for Western Digital, the market will now want proof. They have the flexibility, now they need to execute. Investors want to see the debt actually go down. They want to see that optionality increase.
And a clear plan for what comes next. And for SanDisk, it's about digesting this huge meal.
Exactly. If the secondary prices smoothly and the stock holds support, the cleaner trend may resume. The overhang is temporary.
It's a fascinating look at how a single transaction moves through so many different parts of the market.
It is. It's never just about one stock. It's about the whole ecosystem.
That brings us to the end of this episode of Breaking News to Trading Moves. We hope this breakdown helps you see the mechanics behind the headline.
Just remember, the market moves fast, and these dynamics can change as pricing details emerge.
Before we go, a reminder to our listeners. This content is purely the opinion of the author and is for informational purposes only. This is not financial advice. This is not a recommendation to buy or sell any of the securities mentioned. Please do your own research.
Absolutely. Trade carefully.
Thanks for listening. We'll catch you on the next one.